those who don't know me, my name's Richard Betts. I'm the publisher at Real Asset Media, and we publish a number of magazines, newsletters, and run several of these events, about 60 or 70 a year, focused on investment topics or specific topics, covering the whole market. I'd like to thank very much Kareem and Barbara and the team here at CMS for hosting us. The purpose of this is really to get, for us, some insights on what's happening in the Dutch market, to also get your insights, what you're seeing there as well. So it's deliberately designed to be informal and a smaller group, just so that we can then share thoughts, share ideas, and we will then write that up. Judy here will write that up for Real Asset Insight, so that then that can be read by all of the investors at Expo Real, as well as our international investment community. So the idea is to take some of those thoughts back around the world about what the Dutch market is thinking and what we're seeing in the Dutch market. CMS published the European Real Estate Deal Point study recently, and there are a couple of things that I just wanted to pick out because I think they may be interesting for the discussion. So in terms of the key messages, I thought it was interesting: demand for office property on the rise again. Investment in residential properties accounted for 24% of the market. And just to clarify that this is based on where CMS has been either on the buy side or the seller side in terms of the transaction. So it's looking at CMS data in a way, and it's across Europe. International investors accounted for the majority of real estate investments. A strong desire for security on the part of sellers. Buyers were frequently able to negotiate favorable terms. Again, I think quite potentially interesting. A notable increase in seller-friendly limits on liability. So a couple of interesting things. Now, I wanted to pick out this as well, which was asset classes change over time. And again, this is Europe rather than the Netherlands. But what I thought was interesting there was to see how office had been going down and down and down, and then seems to have reached a point where it's going up again. So it'll be interesting just to see whether that's what we're seeing here as well. And the other one that I thought was interesting as well was the change in time in Europe for international investors versus national investors. So you've got a trend there where you've got 54% versus 46%. And just interesting to see as well whether that is also reflected here in the Dutch market. Just wanted to pick up on those things, share a couple of those. And I've also recently been at Savills with the European Logistics Real Estate Census 2023, which is the third one of those. So I'll also pick up on a little bit of those, but some interesting things coming through on the logistics one as well there. Let's start with some quick introductions. I've introduced myself rather in a long fashion. Timon, since you are part of the home team here, let's start with you. Brief introduction.
Yeah, of course. So my name is Tijmen Brune, and I'm a member of the real estate transaction team. So at CMS we have different real estate transactions teams. So also our finance team is also here. I specialize in real estate acquisitions and disposals, and I focus on logistics, but also industrial and data centers. And I think that, for your understanding, our team consists of almost 20 lawyers, almost 10 notaries, and then we also have a tax department and a construction department.
Great. Interesting around that data center side as well, I think, because there's a lot of focus on some of those alternatives, particularly when we're at Expo Real as well. Rogier.
Good morning, Richard. Yes, my name is Rogier Bos. I'm heading the Benelux office for Berlin Hub since quite a few years. We've built up a quite significant loan book of close to 4 billion, spread over most of the asset classes, at least the core ones. And I'm happy to join this morning's meeting.
Great, thanks. Laureen.
Yeah, my name is Laureen. I am a Director Investment and Asset Management for M&G Real Estate here in the Netherlands, and I'm responsible basically for the Dutch portfolio that M&G has. And both in terms of acquisition, sales, and the asset management. It's a very mixed portfolio. We're active across the most sectors in the Netherlands. And I've been with M&G for almost 5 years now.
Great, thanks. Bas.
Good morning, Bas Wilberts. I'm head of residential and hotel investments with Savills. Our investment team is a wider group of around 24 people, and I had a small team that kind of deals with everything with a bet. So as long as there is a bet involved in the real estate, it will be me and my team. Doing that for 8 years now, helping out on acquisition and sell side.
Super, thanks. And living sector as well is obviously a huge trend at the moment across the market. Peter.
Yeah, thank you. Good morning, Richard and all. Peter Helfrich, heading PrimeVest Capital Partners. We're with 60 people in the Netherlands. We actually act with two different brands. One is PrimeVest, which is tilted towards the institutional investors, and the other one is Holland Imo Group, which is tilted towards private investors. We have roughly 3 billion assets under management these days. And we are a bit in the alternative/real asset sector, so meaning parking mobility on the one side, other side communication infrastructure, which is mainly glass fiber to the home, and then the traditional/operational residential and affordable residential.
Great. So really interesting. We've got different views across different experiences here within the panel. So we'll try and bring those out and get the different perspectives from there. And of course, if you've got points that you want to share, stand up, raise your hand, shout out, whatever is necessary to make me notice you. Maybe let's just start with a kind of overview of where we've been, what trends there are at the moment in the market. Maybe Rogier, just starting with you. What are we seeing at the moment in terms of the market, and where do you see that heading?
Wow.
Big topic, I know.
Exactly. It's quite a broad topic. Well, first of all, it's quite silent. That's not going to be a surprise. I've spoken to quite a few developers and brokers who are literally on holiday. Or I spoke last Thursday to someone who extended his holiday by another 6 months. Because he's nothing to do. That's one thing. Having said that, there are quite a few people who are actually trying things. We see resi developers trying to get things done, especially that. We're seeing buyers going to get bargains. And I think that's actually dominating my days, serving those clients who try to create business in a relatively silent market.
Lorraine, it'd be interesting just to get your perspective as well, because you're obviously a core investor here in the Netherlands. So what's the position at the moment for you?
Well, clearly there's a lot of uncertainty about pricing in the market, and I would say we're also trying things, but also quite careful in terms of our pricing. We're also a bit concerned acquiring something that 3 to 6 months later you would have to adjust the valuation downward. So we're also quite careful. We see that the yield shift has been in the Netherlands a bit more than in other countries, the outward yield shift, and a bit quicker maybe. At the same time, the Netherlands has become quite expensive in terms of transaction costs because of the increase of real estate transfer tax. So that makes the Netherlands maybe a bit less attractive in comparison to other countries. In terms of the markets, we also see it's quiet. We've seen quite a few deals. We looked at last year that I think didn't transact eventually, because I haven't heard anything about it afterwards. So I think many deals were put on hold.
Okay. So deals being put on hold.
Yeah.
And do you get a sense that those are maybe going to come back? They've been put on hold for a little while, and we're likely to see them back again in the end of this year or the beginning of next year, or?
Yeah, I think so. I think they will come back for sure. But probably the price expectation didn't match the offers received, or there were limited offers, or maybe not the right bidders. So I don't know for each deal the exact background, but I can imagine it was something like that.
And Tommy, are you beginning to see more activity? What's your sense? Because you're obviously seeing what's coming through, and also potentially what was coming through and has been dropped and is maybe coming back again. What's your sense of that in terms of activity?
So what we see is that a lot of deals are killed quite early in the process, so more often than, for example, a year ago. And also what we indeed see is that deals that are starting and get on hold, that get back to us. But indeed, and there has been a cutoff from the purchase price, for example. So that's what we currently see in kind of activity.
And Baz, it would be interesting just to pick up with you. You're obviously looking across a number of sectors there as well. Are you seeing the same in terms of deals? Are you beginning to see a little more of an uptick in activity, or are there more people going on holiday, like Rogier says? What's the situation?
I think the best thing to do is to get back to work, because it feels a bit like flying, and rather than take the responsibility to act. But I would say activity is not there yet. It's not really picking up, although the supply of product is definitely increasing in terms of product that is for sale. The question is the right buyer in place? And that's something that will probably take a little longer than we all expected when this whole thing with inflation and interest rate hikes took up. So it's a little different, I think, from the international perspective of CMS, where they see, for instance, like office there's more demand for office. We don't see that in Netherlands yet, but I think it will get back to a more market dynamic than we see today. But what is interesting is that there's more of a shift going on. So I would say alternative investments is more attractive because of yield, but also not only in real estate, but also other investment classes to invest in. So people shy away a bit more from real estate these days, but that causes sometimes to sell, as many of the investment groups also have other investment classes. So they get over-allocated in real estate, and they need to sell some of their assets.
So there's potentially some opportunities, if you see it from that side, of opportunities maybe coming to the market from that basis. And Peter, just coming to you, I mean, Baz mentioned there, a higher demand for the alternatives side. Is that something that you're seeing? Is there more interest, in that alternative side, and maybe also that the crossover with real assets with the infrastructure side is also interesting?
Yeah. Answer to your question is yes, there is more interest, but always relative, I would say. So versus mainstream real estate, taking offices, industrial or logistics and retail, I mean, that has been a bit in the penalty box for quite some time, is even more in the penalty box. And I think, I mean, it all has to do with rising interest rates, right? They have been rising so rapidly. And to a lesser extent today, but still, today there was a discussion on the radio what's going to happen with the ECB today. Will it be another quarter of a basis points or 250 basis points or not? 25 basis points or not? A quarter, I hope so. Yeah. Otherwise it's really steep. But, and because of that, the fact that all our institutional clients, more than the retail clients, I must say, have been, there are many variables, but that's the main for me. I mean, you see that the moment the so-called denominator effect, fixed income all of a sudden has been decreasing values. So it means relative to fixed income and equities, real assets, and real estate in that matter, have an overweight in most of these portfolios. So that static allocation process, which you still see with most of the institutions, leads to the fact that they are not going to invest in real estate. Actually, they have to sell in some cases. They don't want to, because nobody wants to sell in a market like this. But it still happens. And I don't think that will change quickly either. So the market is quiet and will be quiet for a while. Private investors is a bit different, but there's more hunger for higher returns. Logic also, because risk-free rates have been rising. And if the premium is even the same, and you can argue that even, that it means that required returns have to be higher. And the market is not there yet, because then you get the mismatch between demand and supply, right? And it takes some time before values are at a certain level, for the simple fact that we don't value them every day, luckily as well, but that's not how real estate is valued today.
And what's everybody's sense in terms of the, we won't pick whether or not what the interest rate rise will be.
Not 250.
Hopefully not 250, no, that would be a shock. But do we think that we're near the end of that rate rising cycle, and therefore, let's say over the next 6-9 months, there'll be much more certainty and valuations will be clearer, so that, are we sort of almost at the top of this in a way, and then it begins to stabilize? What's everybody's sense of that? I mean, I noticed that Poland had dropped their interest rates plausibly too early, but Just interested to see where we think we are. I mean, do we expect there to be a lot more to come, or do we think this is going to be about it, and then everybody knows where we are?
Well, I think the market tends to think that this is it for, well, after today, if there is an increase,
Yeah.
that might be it for the time being. And it takes some time for people to get used to the new market circumstances. I mean, basically what we have been seeing in the past, 18 months, is a reset of the market. And not everyone is already used to that. And also, it is known that it takes some time for interest raises to have an effect on, for example, the inflation, which is the main purpose of the exercise of the ECB. As Peter rightly said, things will not pick up quickly, or not within now and let's say the first quarter of the next year. Maybe then, we don't know. But if you have a look at interest rate curves, we're still having an inverse curve, which should normalize first as well. People tend to think that interest will go down rather quickly, especially real estate investors have a kind of, let's say, hope that might happen soon, and they might as well be disappointed. It will remain at, let's say, this normalized level for a while.
Yeah. And to add to Rogier on that, I mean, it takes. I mean, the interest rates are rising, and most of us are luckily at the longer end of the stick in terms of fixing our interest rates. But that the longer it takes, the longer the interest rates are higher, the more you will see resets, the more you will see trouble. I mean, that's how it goes, right? And right now, everybody believes that it will last shortly, or that was the general belief probably a year ago. Now the question is it actually, do we see lower interest rates going forward, or are we at the levels or even higher as of today, because inflation seems to be more sticky than it was.
And just in terms of what that means for financing, potentially debt gaps, those kinds of things, are we beginning to see more of those issues, or if interest rates are stable now, that will be less of a problem? Does anyone have a sense of that?
Well, I would say that the main chunk of deals we see is either all equity or at a repriced level, already taking into account these interest rates. So let's say resi deals that kind of close at 4.5-5% gross, so let's say around 4% net. 2 years ago are now at least 125 bips higher. So you see a lot happening in that industry where the private investors always take a different view than, let's say, the international investors. They're more like kind of looking at, especially for resi, to take other strategies. So, for instance, privatization, which is kind of killing the rental market. Let's say, we haven't spoken of regulation, but that's kind of another challenge we have to deal, other than the financial markets. So people take a different view on how they should invest into real estate, but it also limits the opportunities for long income investors as well. So it's a challenge, but I think we always see the glass half full. So I'm a broker, right? So yeah, that's my job. But we also have to think of, let's say, what will be the next opportunity for tomorrow. So different approach, new reality, like you said, but still deals to be done.
Okay, good. I'm going to pick up on that regulatory side in a minute, but Rogier, just in terms of I suppose the financing side, have you got a number of clients coming to you where there's now a gap in terms of where the debt is needing to be refinanced, or is most of that being put off? What's the situation, and how are we going to end up with problems here further down the line, or do you think this is all manageable?
Most of the requests we currently get are indeed refinancings. So yes, that's clearly the case. About trouble, I mean, the trouble we're in is related to capital values and not so much to demand for real estate. There is a shortage in housing. We know that. the vacancies in offices is relatively low. Rent levels in logistics have been increasing lately. Maybe retail is the exceptions, where actually capital values have corrected over the past years. So that's maybe the exception to the general market. But in general, obviously we have to keep an eye on LTVs. And I'm really glad I'm not a valuer, because where you get the reference rates from at the moment. But when it comes to cash flows still seem to be fairly stable. So that will also means that there is a solution for a value problem in case that comes at the table.
Okay, good. And that was certainly one of the things that came through in the European logistics real estate census, that there's been some correction, particularly in the markets, but actually the fundamentals in terms of demand, rental growth, potential was still really significant drivers. So it'd be interesting to pick up on that and some of the other ones. I just wanted to pick up, Timon, with you, just in terms of that regulatory side. I mean, Bas was there mentioning some of the challenges, particularly around residential. It would be interesting just to pick up on that, and also if there's any other regulatory issues that may well be known about in here in this office, but potentially international investors may be less familiar with, for example.
Yeah, so I think that next to the interest, of course, the legislation in the Netherlands is quite an uncertain topic, especially now our cabinet has fallen, so we have elections in November, and until then it's quite unclear what's going to happen. So there's legislation regarding a ban on temporary lease agreements, which we assume that will pass also before the elections. And there's also legislation regarding a third sector in regarding residential leases. So we now have a regulated sector and a non-regulated sector, and there's a proposal for a third sector, which is a mid-market regulated sector. And this mid-market regulated sector is for investors quite a difficult topic, and it is currently quite uncertain what's going to happen with that legislation before November. We assume currently that it will not pass before November. However, sorry to say, Bas, but that's not a guarantee.
No.
But that's our assumption currently. Yeah.
So Bas, I mean,
it's the first topic we have. Let's say maybe second one. So ESG might be the first one. What's cooking in the Netherlands with all the regulation? So that's on resi investment. So it's a hot topic. We've discussed this a couple of times, or many times, by the way. Looking at products, so that it is super difficult to get the full story, and it really requires a good assessment of each and every product you see, be it projects, so new builds, but also existing income-producing assets. And let's say there's many more, but which is far too much into detail. But there is a lot going on, causing a lot of uncertainty. Although, when you take the right view, you still can make proper return. But it really comes down then to a repricing compared to where we started this discussion, that the mismatch between bid-ask is too wide right now. And this is not helping the case, because you have to make another assessment on that pricing.
And this is because it's introducing regulation into an area that previously was not subject to the same regulations, so therefore the investments made didn't take that into account, and they're longer-term investments?
Yes. On let's say on the bright side of things, I would say it also can create more stability in terms of your cash flow projections and stable income, because you know what you can do, because you have a fair set of rent and index. So if you are a super stable long income investor, then mid-rent is actually quite a good thing to do. But then again, another problem arises, and that is construction costs. So for new build projects, it's not feasible to get at a cap rate projects purchased at the cost level where we are today. So
I can add a word to that. The majority of the development cases we currently see show higher construction costs than the capital value in the end. Yeah. So that only works for long-term investors.
Okay, good. And Peter and Loreen, obviously you're both investing in that area. So I guess what does that mean for you? Because it's another level of uncertainty, I suppose.
Yeah, well, if I
Yeah.
can
No.
start.
Ladies first, always.
Yeah, another level of uncertainty that definitely is impacting the sector. Again, also for residential, the yields have moved out quite significantly in the Netherlands and also, I think in general, more than in other European countries. And I think it's partly related to that uncertainty in regard to regulation. On the other hand, there are discussions about regulating rents in more European countries. So it's a trend that is seen in more countries. And for us, we always have quite a conservative underwriting, quite a conservative approach when we do our investments analysis. So yeah, it has not impacted us on the income side. But of course, it is impacting the yields. Yeah.
Okay, good. Yes, because you've got some major residential projects underway here at the moment, haven't you? So
yeah, one underway, actually,
Yeah.
a major one in the portfolio. Yeah.
okay, good. Peter, what's your take on it?
No, yeah, I mean, maybe looking a little bit at history because it helps sometimes to clarify, but residential has only been in the limelight since, I would say, the global financial crisis from an institutional level specifically. Because before that, A1 retail locations were seen as absolutely stable. Now that passed after the internet fell on us. So it was pretty recently. I was myself a big believer in the regulated segment because you knew exactly what you would expect, right? And I think that's probably one of the most important features, that we don't know what you can expect today. And I mean, in terms of rent levels and how can you raise rents, at the earlier days was pretty interesting actually. It was always inflation on the regulated side and there came always a plus. And although it was dependent on income, you knew it was either plus 1% or plus 4% on the inflation. Which was fantastic for an institutional investor. I mean, to have an inflation hedge or partly an inflation hedge is perfect. These days are over. We don't even know if you have an inflation compensation. It's a loan index compensation today. So in that sense, there's so much headwind in that field. Although occupancy levels, where you tend to look at first, are fantastic. I mean, everybody knows that we have a huge mismatch between demand and supply. So, and that will last for at least 20, 30 years probably. So that's fantastic. The problem is everybody's looking at the same spreadsheet and have to value cash flows. And how can you value a cash flow which is uncertain? That's the tough part of it. So naturally, prices moved out, and obviously there again, interest rates played also a big role in that. So many things came together there that I would say internationally, investors are sort of, let's wait and see. I mean, it was already difficult to explain, right, how the housing market was functioning and the point system. And I mean, it took ages to explain. Today, it's even more important because even more difficult because you don't even know how it will look like going forward. And that's tough. I mean, that's where institutional investors are counting on security. And especially with core products, you need that security. And we don't know what it is today.
And if I were to look at it with very much a glass half full
Yes.
approach and be more optimistic about that, I mean, does that mean, though, that if you do get clarity from that and that then the elections mean that this is all verified and everything is done, that then everybody knows where they are and this then will not change for a while? And so therefore then the opportunity begins to come in for those people who are ready to move on those?
I think so, yeah. I mean, but you will see, I mean, that's not only in the Netherlands, it's everywhere, right? That affordable housing is a big subject. It's a huge political subject. It's most of the time actually number one on the agenda. So there will be forces influencing it all the time. And that will be the case. And if inflation has been for a long time under 2%, I mean, it's a long time ago. It feels like a long time ago now. But right now we're at different levels. So the question also there is, will we see that full inflation hedge in your CPI and in our CPI index, which is the normal course of business when you sign a contract here. So, but I think, I mean, again, on an occupancy level and a demand-supply level, it's fantastic. So yes, there will be interest, but we need that repricing first as well, because we price these cash flows differently than we did 2 years ago.
And it's true, you mentioned that there's this is a discussion that's happening elsewhere in Europe. I mean, we had a session on Iberia, and exactly the same topic that was just before the summer was very clear in the Portuguese market, where there was new regulation coming forward, but actually uncertainty about which bits of it would be passed, which bits wouldn't. Maybe it was going to be, positive, but there was another 5 months to go before the decision was made, kind of thing. So, a lot of changes there. Let's talk a bit about some of the opportunities and also what type of capital is beginning to look. Overall in Europe, their international capital was above domestic capital. What's the situation here? Are you seeing anything, Timon, in terms of the kind of clients that are coming to you? Is there more international capital looking, or is it some of it being put off by uncertainty? What's the difference here between maybe the take from the international and the domestic investors?
I think we're still being approached by new international clients. So there are still parties who are looking to the Dutch market. However, there's still a lot of inactivity, of course, as we earlier discussed. So it doesn't often come to a new transaction. What we do see, though, is that a lot of the transactions we do currently are funded by equity and not by debt. And we also see a lot of sale and leaseback transactions. So I think those are the two transactions. And if we can link that to national or international buyers, I don't think so. I think it's more a way of that the parties who are investing currently in the Netherlands, that are parties who are able to fund with equity.
And is the sale and leaseback side mainly around the financing part of that? Do you think, is that the sort of goal is that why we're seeing more of those transactions?
I think so, but I also think it has to do with the fact that there is not a lot of offer currently in the market. So brokers are actively looking for offer, and that's how sale and leaseback transactions are something we see more often currently. Yeah.
A bit, but I think the equity is coming. It's kind of 50-50, like your chart showed from the CMS research. And don't forget, internationally, the Netherlands is still being seen as a kind of a safe haven. So if you have to deploy capital, despite all the things that we are currently talking about, in comparison to many other jurisdictions, it's still a good covenant to invest in. Also taking into account the health of the current economy. I recently saw research that in the EU zone, the Netherlands is actually the only economy which is actually overheated, which means that even a small recession might be, not at a micro level, but at a macro level, be a good option. And we need here and there quite a lot of staff. Many decisions are driven by the lack of talent in general, or the war for talent, I should say, and therefore it is still in any asset class a good place to invest.
Okay, good. Well, let's pick up on some of the fundamentals driving the sectors. Let's look at the different sectors. Let's start a little bit with the office, for example. Obviously, the comparison in the chart there was interesting, but are we beginning to see more than that? We seem to be avoiding the sort of US office Armageddon that everybody is seeing there. Yep. And if I look around here, for example, there's still very active development in terms of the office sector, mixed use, very vibrant part of the city for certain. But what are we seeing across the sector? And also, just picking up from the ESG perspective, what's happening now with those older offices that are less compliant? Are they actually being emptied, or are they, what's the situation there? Who wants to pick up on the office sector?
Well, maybe briefly, not being an office guy, but but it's, what we see is a clear polarization. So either it's a good building or it's not a good building. So it's a kind of a binary, getting into a binary market where at this location at the South Axis, the traction and mixed use, like you said, Richard, is well mixed. Whereas the monofunctional office parks already suffered, but that's a trend going on for more than 20 years ago. That might take a little longer to further fade out, to be honest. And I think definitely Netherlands is not the US Armageddon. Commuting times are far less than US or, for instance, bigger metropolitan areas like London or Paris. So I really don't believe that it will be kind of the same battle zone as we see in the US right now. What we do see is that basically if you have a good office with the right credentials, also in terms of ESG, companies and mainly the corporate ones, but also the bigger family businesses are really keen to be in an office that has a BREEAM excellent, is ESG compliant, et cetera, et cetera. So it's a real kind of, it's not only a marketing tool, but it's also laid out in the entire company. And funny enough, then price becomes a secondary criterion, I would say. Whereas the older offices on secondary locations are quite costly to renovate and get it to a level that is then ESG compliant. So here you have it. I think that's the opportunity to further rethink those locations that are non-public transport hubs and don't have the mixed use like we see in city centers.
Okay, good. And Laureen, you have some office investments here, I think.
Yeah, some, only two actually.
Okay.
In Amsterdam, both. Yeah, one building is located in the center, and the other one in Amsterdam Southeast, center part of Southeast. So in Southeast is one of these areas where vacancy is increasing. I think 2 years ago, maybe it was around 6-ish. Now it's reached, I think, 11 approximately. So that's definitely, vacancy is increasing there. I think that also has to do with the type of tenants that is typically based there. It's more administrative, financial services, and typically those tenants have seen the COVID effect of the office usage more than maybe the tenants that typically occupy office buildings in the center and in the south axis. And in the center, I think vacancy is still quite low, increasing slightly, but still at a relatively low level, below 5%, I would think. And I'm looking at Bas, but I think around 5. And take up there is decreasing a bit because, the past years the main take up was coming from the tech sector. And of course, investments in that sector have decreased a bit, so those companies are also a bit less active. But yeah, that's what I can say about the general market trends. Yeah. Okay,
good. And Rogier, you're obviously looking at it from a different perspective. There will be, a chunk of office within your kind of loan portfolios. What's your sense of the office market more generally? Are you more cautious on that, or and also, I guess, in terms of the transition for offices which, may not be of the highest green credentials at the moment? How is that financing going to be done? Is that something where you're supporting colleagues on that? And is that relevant here in the Dutch market?
It's not getting easier because ESG is a condition, sustainable building is a condition, and if it isn't, it has to be converted to either a very nice office, which again attracts talent, or it has to be converted to something else. And most of the obsolete office buildings have already been converted over the past 10-15 years in the Netherlands. So the question really is, what are you going to do with the rest? And that is really not easy. It's also hard, of course. People are getting quite nervous, having in mind the news from the US, and this week in the Financiële Dagblad, the HSBC Tower, which I wasn't, to be honest, aware of. That is quite a challenge to solve these issues. So for us, the office portfolio is not dominant in our portfolio. That's RISI. Yes, indeed, it's good or it isn't, and it's not always easy to make the right choice.
Right, so a real polarization in the market, really. Okay, good. And in terms of that sustainability side, Timon, what are you seeing? I mean, are you beginning to see much more of a focus in terms of clients on the ESG side, and also obviously when at what point is this asset no longer going to be viable because of the way you're expecting ESG to move? What are you seeing there?
Yeah, so since 2019, we see some legislation coming up regarding ESG, also, for example, the EU taxonomy. More investors are asking us for also due diligence on that part, and also to see whether properties or assets are stranded and in which year. So we even see now with developments that the EU taxonomy regulation, which is not even binding for every party yet, but we already see that the requirements from the EU taxonomy are already taken into account with LOIs, for example, so that properties should not be stranded before a certain year. And I think that's interested to take into account, and also to consider that the EU taxonomy, but also the Carbon Real Estate Monitor are items to closely monitor.
And is that relatively new in terms of the NOIs there you're talking about? Because that's not required by the regulation, I don't think. So that would then have to be something that potential investors
that's
are
relatively
demanding.
new. So financial parties are already looking closely to that, because of course their fund also gets a qualification based on the compliance with EU taxonomy, for example. But for other parties, I think it's relatively new. But bigger, especially, for example, German investors are already asking us to take that into account with their due diligence. Yeah.
Okay, good, interesting. And Laureen, is that something that you're doing across the fund in a way, across the portfolio, where you're looking at when is this going to be stranded potentially?
Yeah.
What do we therefore need to do?
Exactly, across the portfolio, and also when we're looking at new acquisitions, we have, especially for developments, what we call the Sustainable Development Framework, which is a set of requirements for new developments, sustainability requirements. Yeah, and that also includes the stranding year. So we definitely have that incorporated in our approach to looking for new products, but also our existing portfolio. Yeah,
Okay.
I think it's a good thing. Yeah.
Yes. Good. Let's pick up a little bit, Peter, with you on the alternatives side there, and some of the areas that you're looking at. Let's start though with the residential side. You mentioned that the fundamentals are good, and that there's really a kind of issue. It's at the moment with uncertainty, but is that across? And I'll pick up with you, Baz, as well on this. Is that across all the kind of sides, whether that's affordable housing, residential more generally, student housing, senior living, co-living? I can see Bart is here somewhere for co-living. So is that across that whole living sector, would you say?
Yeah, I mean, in general, yes. I mean, they're all quite different. I mean, you mentioned them in one word, but that becomes, one is more operational and one is rather on long leases and more core. But I would say, yeah, I mean, general living right now, there's clear, I mean, on whatever side there's a mismatch between demand and supply. So you're either a student or a starter or looking for an affordable home. I mean, it's not easy, right? So yes, they're all interesting. I would say senior care is very specific in the limelight of attention because of the demographics of our population, and that's not only in the Netherlands, but that's again everywhere in Europe almost, and to a lesser extent in the US. They have a little bit of younger population, but even there, there's a clear view on how are you going to live, because we all, I mean, it's not only demographics, but it's also the fact that we become older and older, which is a way of looking at where do you really want to live after you're 60, 70, 80, 90, and maybe going forward even after you're 100 years old. So that's one. On top of that, health and healthcare. I mean, kind of the same drivers in that sense. Very interesting. So yes, I mean they're all extremely interesting areas. That's why I said I'm looking at the glass half full. It's a fantastic world to be in as an investor, because you don't have to be afraid of occupancy levels. It's more that it's the combination of the economic environment and the regulations we have seen coming to us. That there's more insecurity, hence it's harder to really value these future cash flows today. And again, that's what it's all about in the end of the day, right? That's why institutions invest in real estate.
And is this mostly a development play, i.e. these buildings don't exist or the right sort of buildings don't exist, so therefore actually there's got to be active development across the market?
There is. I mean, we are not. We don't do any development play. We are pure core player. So we look at long, stable income returns. So for us, it's a yield play more than anything else at the moment, and that's why it's so important, and that's why there's nothing to do really, because the levels we want to buy is not something someone wants to sell at the moment.
Right. Okay. Lorraine, you're actively forward funding, I think, in some ways, or working together with the part of the development project.
Forward funding, if you think about student housing, as Peter's saying, there's a huge undersupply in the Netherlands. I think it's 50% approximately of the students that are not renting, 50% are renting, and of that 50% that is not renting, around 75% would like to rent, but unfortunately they either cannot find it or what they can find is too expensive for them. So I think the fundamentals are really strong for the student housing sector, definitely.
We now see the first signs of more of a mature market as well. So let's say the senior living market, healthcare market, is kind of known as kind of rather granular, so relatively small lot sizes. So either package a group of properties into one portfolio and then trade it off, because on an individual level it's too small most often. And there we see, I would say, still a lot of demand with institutional investors, also given their impact in investments. So Dutch institutional investors buying healthcare. Funny enough, they are not really keen in buying student housing, which I believe is a pity. But by the way, but there is a lot to do in that field. And what is interesting about the student housing market is that, like you said, Peter, it's kind of operational. And as size has increased, it's more tradable also from an investor point of view, where I think over the past years it were mostly new builds, so just projects. We now see income producing assets being traded, and I think that's a bit lagging compared to the UK, which is, I think, the most mature market in that respect, even more market dynamics than the US every now and then. So, but I think we're getting towards that situation of the UK with professional operators, core buyers, but also private investors who would like to acquire those types of assets, of alternatives.
Okay, good. And Peter, maybe just give us a quick view on some of the areas, I mean, that you're active in, parking, for example, those kinds of ones which, may not be ones that investors would normally look at, for example.
True, yeah. I tend to say mobility more and more, but that's also for our own sake, because it sounds so boring, parking, right? And it's so much real assets or real estate based. But I mean, it is. I mean, mobility in general is a big issue. Also, if you look at the E from the ESG, the environmental part, and cars play a huge role in that. I mean, we love the fact that that's why we are an active parking investor. One, yields haven't shifted so much down as all the other asset classes, which helps in the repricing of these cash flows. And two, they tend to be operated by a handful of operators who know how the market works, have been into Corona, which is probably the hardest part to be, or has been the toughest part to be in as a car operator, because everybody has stayed at home. So even an economic downturn will be much less severe than what happened during Corona times. So that's proven, I would say already. And they tend to sign 20-25-year leases with the CPI index, so that also helps. In that sense, it's a very secure cash flow again, which is much easier to comprehend for institutional investors. But of course, the mobility effect plays a huge role, because especially in the larger cities. Cities don't want to have cars anymore in the city center. So there will be a push towards what are we going to do with these parking garages in the inner city, towards having more parking garages around the cities as a transport hub, where you end up with your car, and then you go either by foot or by bike or by other electrical transport. And these cars will be longer, will be staying longer in the garage. So what other functions can you do other than charging your car there as well? Think about logistics and making sure that goods are delivered and returned again. So it's an interesting. I mean, it sounds very boring, but it's actually an interesting subject. So yeah, that's a big belief. Senior care for sure. Like I said, one of the main features for us is, and it's not an easy one because one, it's operational, and two, it's very much dependent on the government and the subsidies attached to that. And if you look at, there was a big newspaper article about the margins in the care operator world. They are extremely marginal, meaning 1 or 2% profit margins, which is extremely low. So you have to really look at how is your care operator going to survive, and how will the care market look like. And what Bas said, in the earlier days you had units of 20, 25, or buildings with 20 to 25 units. And the name of the game is how can you make it big enough to be able to have an operational efficiency, but small enough to be interested as for the occupier to stand in. So that's the trade-off we're really looking at, and that will be a huge development play for the next 10 to 20 years.
Okay, good. Yeah, Rogier, go ahead.
Yeah, because we selectively finance parkings in the Netherlands, and and one of the things we like about it is that the cost level is fairly low. It's driven by capital markets, whereas senior housing, care, but also hotels are very cost sensitive. And as Peter rightly said, it's very difficult to operate senior housing complex or perhaps a portfolio and to really grasp the cost level. In hotels and leisure in general, and restaurants, it's kind of hard to make good money in there. There's sufficient demand, both for care or a cup of coffee, but staff is expensive and also very unpredictable. And parking is quite predictable. And the more operational the asset gets, the more difficult it is to assess the risk. So therefore, we still like RISI.
Okay, good. And just in terms of logistics, what's the situation there? I'll come to you, Laureen, in a minute on that. But how are you seeing the logistics sector from the financing point of view?
Logistics is quite closely linked to capital markets recently. I mean, it has taken quite a long time till rent levels could finally go up. Well, that has happened now in a couple of locations. Demand still seems to be strong. Values have corrected, which was kind of necessary. The question mark really is how much logistics do we really need? Because even though the market has shifted partially from retail to the internet, the demand for product in general has remained more or less the same. So it's basically it's a reorganization of supply chains. So for the time being, since rents have gone up, apparently there is demand, but we've built quite a few boxes over the past years. And there must be a limit to that growth.
Okay, good. And Timon, are you seeing kind of demand still in that sector in terms of the investor kind of intentions, investor interest?
Yeah, so we see a lot of demand in that sector, but we also see that there is a gap between what sellers are asking and what potential buyers are willing to pay. So I think that's something that's very difficult in that sector of the market.
And there's quite a bit of crossover between some of the logistics operators and also those looking at data centers, for example. Are you seeing that? And I suppose, is data centers something that is small at the moment and is set to grow in your view? How do you see that?
So there is a lot of demand for data centers because it's a very interesting market, but I don't think that it will be growing the couple of years. And the main reason is that the government is currently very much verifying and checking and involved in which locations should be used for data centers. We also have now a hyperscale ban for data centers, so there's not a possibility to develop very large data centers currently. We do see that there are still some zoning plans who, for example, allow the development of a data center for example, 2,000 square meters. And also, because the rent is so high in this sector, that's still interesting for investors to look into that. But we also see that also the provinces and the municipalities are involved currently and are trying to also get a ban on that. That's maybe also a link to the logistics sector, is that, and the logistics sector, indeed, there have been a lot of boxes built next to the highways in the Netherlands, and I wouldn't be surprised if provinces and municipalities are also going to be involved in the location of huge warehouses and distribution center in the near future. So regarding legislation, that's also something that is interesting to monitor.
Yeah, and there's a big focus as well, obviously, around power, self-generation of power, with a desire that these larger kind of areas don't take off the grid. So there's a lot of interest around that. Loreen, how are you looking at because you're investing in logistics?
Yeah.
What's your take on that? I mean, interestingly, we had a discussion around some of the key trends, and although e-commerce may have dropped back a little bit and now be on more its pre-COVID trajectory in a way, that then there's nearshoring and friendshoring and the movement of manufacturing back into Europe. So what are the drivers that you're seeing?
Well, I agree a bit with Rogier, how much more logistics do you need? On the other hand, yeah, the occupational market is very strong still. The vacancy levels are, I think, still record lows in the Netherlands. Yep. So there is still a strong demand for logistics. And as Tijmen mentioned, the new supply will be very limited. Either it's through because of nitrogen issues, or it is related to, what in Dutch is called the boxification of the Dutch landscape. And the general perception is, I think, the political debate is a bit about what do these boxes actually add to the Netherlands. I mean, in terms of landscape, it can be polluting, and in terms of economy, it often doesn't add so much to the economy. It's often lower skilled labor that gets hired for these distribution centers, and we already have a very low employment. So that's a bit the political view on these boxes, and that will likely lead to more legislation and limitation when it comes to new development. And what Bas was saying before, also tenants are looking so much more for the most sustainable, newer schemes to lease with the best BREEAM labels, EPC with PV panels, and often that's more the case in the newer projects. So yeah, how much more do you need? But I think there will also be a run to, a bit of a shift to more quality or properties with better sustainability criteria. So yeah, I think it's still a good momentum for logistics. Also there, the yield shift has been quite big. We came from a sharp level, of course, also in the Netherlands. But I think there's still opportunities. Also, what we see, that opportunities that were offered pre-summer, that were a lot of forward funding opportunities with all the new product, with all the ESG credentials, with the lease in place. Those didn't sell either. Those developers have decided to construct themselves. Oh. Those projects have reached completion or are now close to reaching completion, and they're being offered to us or re-proposed. They go back to the market. So that will be interesting opportunities, I think, coming. Yeah.
Okay, good. given you mentioned about hotels at the beginning, Baz, it would be rude
Love it.
not to at least touch on hotels.
Yes.
There's about 5 minutes left, so I just wanted a kind of brief update from you. Certainly when I've been coming recently, and indeed travelling across Europe, hotel pricing seems to be significantly higher than it was before,
Yeah.
including flights and everything. So
Exactly.
what's your take on that? Does that mean that everybody's having a fantastic time and hotels are full, or...?
Yeah, I think so. Well, I think the two things happened. Let's say business travel didn't came back as much as pre-COVID, but definitely occupancy levels throughout, let's say, Europe exploded, and it was not only kind of a revival or of the holiday, but also to see that things are getting back to normal, but things have become more costly. So. It was already mentioned, and to find the right staff in restaurants and hotels, extremely tough. When we speak to hoteliers, that's their main thing. Then again, energy prices exploded, so that all comes down to you charge it to the client in the end. But I have to say, ADR, so the daily rates have gone up. Amsterdam is really flourishing right now. So that's a positive take. Even still, they have to pick up from a very low level of returns and revenues since COVID, paying back, let's say, subsidies that they received. So it's not easy, but it's at least showing some positive results. And I think the overall sector is quite positive how things are changing, and it also causes more kind of innovation in that sector. I think the main challenge for hoteliers is to see how they can bring down the usage of energy. So you can have a green lease, you can have a green building, but if your clients, take a shower for 2 hours, then your energy price is still very high. I'm not pointing to you. But,
I don't know why I'm feeling guilty. I don't...
Got me. But on the hotel market, bit same like parking garages. So on the operational bit, and to be honest, I love it because you can see what's actually happening inside a property, causing the value of the property. It's picking up, but it's an enterprise. So it's a company that's working on a daily basis. So you can monitor how the business is going, and as yields were on a different level compared to logistics, resi, and core offices, that kind of delta between bid-ask is a little different. But you have to ask here, obviously, on the financing bit. But most, let's say, retail banks kind of shy away from hotel investments, although they still finance it. Alternative lending, you see there a lot of private equity moved in because they want to see the opportunity coming from the COVID times and now post-COVID times into normality. So there are opportunities there, and a lot of regrouping of hotel operators funded by family offices, private money, to kind of cause kind of a shakeout, I would say, in terms of the hotel industry. So probably less of hotel companies operating. But financially stronger groups that will, take their share in the market. So it's an interesting time, and market dynamics definitely have gone up. So if I had a handful of hotel deals over the past 3 years per annum, I would say we definitely see more happening right now. So let's see where it goes. But I'm positive about this industry.
Okay, and just very quickly on retail, which, over the last 5 years, nobody's really wanted to discuss at all. But interestingly, over the past, I would say 4 or 5 months, I've had, I think, around 5 or 6 people talking about that, they understand where retail is in the market, and so therefore they know what they're dealing with and are thinking about raising a fund for retail, for example. So has anybody got a positive word for retail or a negative word, or what's the take here? Because I know there have been some issues previously with particularly the retailers going bust. But are we through that? Where are we? Are people looking more, optimistically or not?
I think, maybe if I may, but retail has suffered for such a long time, and one of the persons regretfully who sort of announced that the bottom was reached 5 years ago. So I'm completely on the wrong end there. But I would say pricing now looks at least very interesting, and you can argue. I mean, there's a bottom somewhere, right? That's for everything. And the great thing I always found was retail, and especially then. I mean, had a divide between daily goods and durable goods. But if you're in the middle of a city, in the middle of a town, at least land values will be very stable, if not rise. So what you have seen there, and also take into account that in former days, retail in the inner city was really seen as the driver of the value, and most of the time there was some kind of residential on top of that, which was completely empty. Nowadays, the focus shifted towards the residential versus the retail being lackluster. But I would say, I mean, if you would take a bet, I would take a bet on retail. Yeah. The problem is I'm not in the betting industry, and my clients are neither. So I would like to see some proof on that. But somewhere I see, I mean, you get retail units today for 8, 9, 10% initial return. So you can fall quite 30, 40%, and it's still interesting. And the question is, where are the rental levels, and where is the volume of retail offer today? We have seen quite a development in that. So you see a much more compact city in terms of its retail. Occupancy levels on these areas are still extremely good. Never have been very low. If you talk about the good locations, and rental levels have almost halved on these kind of locations. So somewhere there is a bottom there, yeah, for sure.
And that's the big question mark. I was silent because you were asking for optimism. It's really hard to estimate how much rent you can pay out of selling cups of coffee. Yeah. And there is a lot of change going on in the retail market. There's the high-end retail, which is functioning very well. There's a lower end, which works out. The supply chain is changing completely. Yeah. And if you really have to know what you're doing before you're investing in retail, and of course, location is the key. We're positive about convenience retail still. That's still working out. Also, yields are fairly stable. The reason why yields didn't come down on the remainder of retail is because they have already done that previously. But it's a very challenging asset class.
It is, yeah. Yeah, and on top of that, we still see the consequences of Corona, because that was so much subsidized during these days, and it has to still be paid back to the government as well. So that's also a hangover still in that market.
Okay, so that's creating an extra challenge, if you like, that may not be the case in other countries or other jurisdictions, for example.
Correct. Yeah.
Okay, interesting. We're right up against time. There will be coffees next door to carry on. If anybody's got a burning question that they want to ask, then please do let me know in the next 5 seconds whilst I'm scanning the room until the end of this sentence. One, make it quick, but.
I come from, let's say, co-living scene and alternatives, and we've been hearing about supply, demand, disbalance in the living sector, and we've been hearing about student housing, we've been hearing about senior. How about the middle part? So housing for young professionals. We've been also hearing that there are challenges to attract talent, and
True.
And I keep hearing all the discussion around topics and demographics, but not really like the meat, let's say, the meat part of it, which is young professionals, young family starters. I think that's where the problem currently is. That's why we're also addressing this problem with co-living conference next week here in Amsterdam. What is your take on this? Is this topic avoided because of the regulatory aspect of it? Is it because of the operational side of the real estate that can be?
It might be interesting to hear what the CMS has to say about this, because I think it is really something that policymakers still have a lot of difficulties with to kind of pinpoint, but also to understand what the necessity of this kind of co-living could be, or let's say facilities that mix starter homes with students. Basically, the best way to do it is to have hospitality zoning, so like a hotel zoning for your product, which is, to my best belief, absurd, because it's not you're staying for a longer term than just a period of time to do a project or stay overnight or a week for a holiday. So that it's a different type of product, and it's super difficult to create the right policy around it, especially since temporary lease is now being banned. Is not helping the case. It's not really helping the case, and it's not only my personal view, it's also from a more professional view, where I would say you need flexibility in the market to provide people that are not there yet to make a decision whether they would stay in the Netherlands. I mean, the world has become smaller, right? It's not just the Netherlands with the boundaries, but we still think as such. And that would be definitely an opportunity in my world to improve that business, but also causing more flexibility and also probably causing more dynamics into the resi market from your living career.
There's an exception for expats. So there are some regulations that take into account indeed what you're pointing out right now. But I agree. There's a lot that still needs to happen.
Thanks very much to everybody for being here as well on a Thursday morning when it's so beautiful outside. Thank you to the panel, really interesting discussion. And thank you to the whole team here at CMS. Everybody will be available for coffees next door. So if there's a question you didn't want to ask in public but would like to now, now is your chance. But because we're all together, then we can actually do what we can't do online and applaud ourselves for being here and the panel as well for sharing their insights. Thanks very much, everybody.
Thank you.